Good morning, everyone, and welcome to our follow-up webinar on tax reform. I'm Stacy Dreher, the Marketing Manager for James Moore & Company, and I'll be your host. And with me today to present are Aaron Spivak and John Van Duzer, CPAs and tax partners with James Moore & Company. And for those of you who haven't had the pleasure of meeting or working with Aaron or John, Aaron oversees our tax practice, where she manages and directs the day-to-day operations and analyzes and plans for the impact of new tax developments, such as tax reform. And John specializes in providing advanced tax strategies and consulting services for real estate developers, investors, brokers, property managers, and other businesses within the real estate industry. And we have a lot of information to cover today, but before we get started, I just want to touch on a few items. We encourage you to ask questions throughout the webinar using the Q&A function within your dashboard. But keep in mind, we'll answer all questions at the end. And if we don't have time to answer your question, we'll be sure to follow up with you after the webinar. If you do have issues with technology, call the 888 number written on your screen. And lastly, this webinar is eligible for 1 CPE credit. And after the presentation, we'll email you a copy of the slides and the recording and any additional information you'll need to obtain your credit. So without further ado, Aaron, let's pass it on to you.
Thanks, Stacy. So hello, everyone. Thanks for taking time out of your day to tune into our webinar on an update for tax reform. I want to apologize in advance that with back to school time starting, that means 2 things. 1 is traffic and 2 is germs. So I do have a cold. So if I cough throughout the webinar, I apologize. It's hard to believe it's been a little over 8 months since the tax law passed. We did a webinar back in early January and anticipated that we'd be doing another one in early July with updates on regulations that the IRS would issue. Unfortunately, the answer is the IRS issued some in August, and we have some clarifications, but not all, and the regulations recently are proposed, not final. I will give the IRS a little bit of leeway in the fact they were challenged to write interpretations of a law that was passed in a short amount of time that had some last-minute deals baked in to ensure it would pass. If you will recall watching the news in December as they talked about last-minute wheels and deals. Given all that, as CPAs, what I think we can say today is that the tax reform law didn't make things simpler for businesses. It certainly did for individuals, but businesses, it seems like it's a little more complicated. The forms to complete some of these calculations or changes may take longer for the IRS to draft and issue, which may delay filing season next January. And if you're a closely held business or hold interest in multiple companies, multiple real estate holdings, Schedule Cs, it is probably going to be prudent to consider not filing all of your tax returns, the business and the personal, until you can look at them as a whole. Typically in the past, we've tried to finish business returns quickly as possible, and then the 1040s would come a little bit later. Now it may not be a good idea to do that, and you'll see that throughout this webinar. Many of the decisions that need to be made at an entity and a personal level are very interdependent on each other and can't be made without looking at the group as a whole. At James Moore, we stand by our vision that we provide valuable advice to our clients, and we aren't just about putting numbers on a form. But with tax reform and all the opportunities for planning, if you don't normally engage in year-end planning with your CPAs here, please reach out to them. Please make sure that you aren't going to miss out on any opportunities before year-end. And in addition, tax planning this year and in future years will actually reach beyond December 31st. A lot of times tax planning is thought of things I have to do before year end, but in this case, as tax returns are prepared, there may need to be strategic thinking related to depreciation, interest, losses, and something called QBI, which you'll learn a little bit about later. And so now to understand why, let's get started. One of the first things we're going to talk about is C corporation tax rates. One of the big things that came out and got a lot of press was that they lowered a C corporation's tax rate from a tax bracket between 15 and 35% to a flat federal tax rate of 21%. Typically, C corporations paid around 34%, and remember, C corps pay their own tax. So once they actually pay the tax, any money then distributed to shareholders after that are taxed again, the famous double taxation. So I think we got a lot of questions that said, hey, I'm an S corporation or I'm a partnership. Should I convert to a C corp to take advantage of this flat federal tax rate of 21%? It's complicated. I don't know how to say that in a different way, because you still have the double taxation in there. It may not be advantageous to do that. One of the reasons might be Florida tax, because in a C corp you still pay a Florida corporate income tax, where on the individual side you don't. If you take out money in any other form besides compensation as the C corp is operating, you get taxed again at up to 23.8%. So your overall effective tax rate could be as much as 44%, not the flat 21% everybody talked about, right? And we actually developed a spreadsheet to help analyze this so that we could help our clients decide if it made sense to move to a C corp versus an S corp.
So Erin, when do you think it would be good to be a C corp?
So I think if you're not taking money out of the company, a lot of times people are letting their cash reserves build or their assets build, or they're putting capital in, so they're not taking out other than a normal wage, and they plan on not doing that for 5, 10, 15 years. Then you really need to analyze whether it would make sense to continue to pay at that 21%, because you potentially have a liquidation event in the future, but it's far enough away that it would take advantage of that.
Right, so it's almost like a present value calculation.
It is. It's not as simple as 21% versus 37%. Nope, definitely not. All right, one of the next things that they made a change to is bonus depreciation. So bonus depreciation has been around since the early 2000s, and this is where they allowed you to write off 100%, or in past times 50% of the cost of a new asset placed in service. And it was originally put in place back in 2001 to stimulate the economy and to encourage businesses to invest in equipment, tangible goods, and such. And this depreciation has gone on and off throughout the years. This new tax law put it into place that starting on a weird date, September 27th, 2017, through 2022, you could take 100% of your cost of putting fixed assets in service. You could write it off in the current year. What they did in addition was this used to only be new property. They've expanded that definition to now be used property. So before, you had to make the decision if it was a used property, if you could take 179, you did it, or if you took bonus depreciation. They kind of alleviated that question for us. The other thing that they did was they allowed it to be taken on more than the normal assets, which is the definition of what you could take bonus depreciation on.
Right, and I think the used property was a huge provision. So in real estate, what we've seen is you can buy an apartment complex or a office building and perform what's called a cost aggregation study, where you break out the various components of the building into their depreciable lives. And anything that is not classified as real property can basically be expensed in the year of acquisition.
Yeah,
so
that's huge.
That could be 10 to 20% of the cost of the property, depending on what it is. But we'll talk about these deductions, that it may not be to your benefit to do that because of all the limitations that have been put in place.
Definitely. What I was going to say on cost segs, it goes back to that net present value, because depreciation is the timing difference. So looking at accelerating those deductions into the earlier years, let's say the first 5 or 10 years of having the building placed in service, versus depreciating it over 27.5 or 39 years, and whether it's worth it.
Right.
The other thing they made a change to was Section 179. So Section 179 has been around forever, and it is where they allow you to write off the expensing of any sort of fixed asset purchase other than real property in the year that you acquire it. And it always had been for new or used property. It didn't really matter. And that limitation previously was $500,000, and they increased that expensing limit up to $1 million. And they also said, hey, if you place in less than $2.5 million of assets during the year, you can take that full $1 million. So one of the questions that we often get asked is, which one is more advantageous, bonus or 179? And it really depends on the situation. 179 is somewhat limited because if you're a passive investor, you may not be able to deduct the 179, like a trust or estate, or you're not active in the business. But on the other hand, in the state of Florida, 179 is allowed for Florida corporate income tax. The bonus depreciation, they make you take over 7 years. So you kind of have to look at both sides. They also expanded the definition of qualified tangible personal property and real property for 179, and this was kind of a big win, especially for apartment complexes where they have tangible personal property that used to predominantly furnish lodging or connection with furnished lodging. They allow you to take 179. This could even be if you just had a rental house, right? And then they also said improvements to non-residential real property, such as roofs, heating and air conditioning, fire protection, alarm systems, security systems could be eligible as well, where those previously had possibly had to go over 27 and a half or 39 years.
Right.
Yeah.
So you look at the depreciation again, it helps speed up the deductions.
Yep.
So Aaron and John, before we move forward, let's take a quick break to do a polling question. So you all should see the questions on your screen. Take a couple seconds to respond. And remember, for those of you looking for CPE credit, you'll need to respond to the polling question. So we'll give you all a few more minutes. Looks like we have a few more answers coming in. All right, we're going to close out the poll.
Yeah, less. That's what I think a lot of people are going to think and hope, really cross their fingers that they are going to pay less taxes. So again, it will come down to individual situations, as we've kind of talked about before. So the next thing that they made a change to is something called Likekind exchanges. This is under a code section called 1031, and it's been around for a long time, where if potentially you have a low basis in an asset because you've depreciated it over a certain amount of time, and you're going to sell that asset and roll the proceeds into buying a new asset, that effectively defers the gain, right? Because you're not paying tax under this Likekind exchange rules. What they did is they said, hey, we're going to continue to allow you to do this for real property, like actual buildings, houses, and such to that case, but we're going to disallow it for tangible personal property, vehicles, planes, etc. As a CPA, I will say on the vehicle side of things, unless you were able to write off 100% of that car, or usually a truck or SUV in the first year, a lot of times we saw people trading in vehicles and deferring losses, not gains.
Right, we see Camrys with $100,000 basis.
Exactly, which isn't always fun. I'm always like, please sell your Camry, don't trade it in again. But for those people who did, and you did get the fast depreciation, and they're just trading that car in for a new car or a new SUV, they're going to pay gain even though they didn't get the cash for it. So that is the downside for it. But again, with bonus depreciation of 179, they may be able to write off a significant amount of the new asset purchase. So maybe a wash. Next thing, which is a more complicated provision they put in, is something called the business interest deduction. Now, the first thing I want to kind of talk about is that this only applies to businesses that have gross receipts that exceed $25 million. And you do have to look at that on what is called an affiliated group basis. So you have to look at all your entities, and if they meet this affiliated group test, group all their gross receipts together to decide if this 30% limitation applies to you. If you're a single business or a single real estate holding that has less than 25 million, you don't have to worry about this provision. So they went in and said, hey, we're going to disallow if you have interest expense that exceeds 30% of your adjusted taxable income. And what they did is they said, and if you exceed 30% of your adjusted taxable income, you're not going to be allowed to deduct the interest that exceeds that, but you do get to carry it forward indefinitely, which is nice. So you don't lose the deduction, it just kind of goes forward. One of the things that we really want to talk about is the adjusted taxable income and how you actually calculate that. So through 2022, you take your taxable income and you add back business interest expense, right? Or interest income if that was the case. Net operating loss deductions, 199 CAFE pass-through deductions, which we'll talk about in a second, or in a few minutes, John will go over. And then a big one, depreciation, amortization, or depletion before 2022. Once you get that adjusted taxable income number, you take 30% of that, and if your interest expense exceeds that, then you're going to be limited in the deduction that you take.
Right, so it's a EBITDA through 2022.
Yeah.
And then it's EBIT after that.
Exactly. So once 2022 hits, you can't add back depreciation, amortization, or depletion, which is when bonus depreciation and 179 really start to come into play.
Right.
Yeah. So they did put an exception in for real property trade or business or farming businesses, which I think they recognize that these could be highly leveraged type companies. And they said, hey, if you don't want to be subject to this interest expense, you can do an election out and choose to use depreciation under ADS, which is an alternative depreciation system. What this does is it makes you take assets over longer depreciation periods. Like, for instance, a piece of equipment might normally be for tax purposes depreciated over 5 years. You could elect to do it under ADS, which might be 9 years, and also make it ineligible for bonus depreciation. Obviously, you would want to make this election unless it was advantageous, unless that interest expense disallowance was going to be a big issue.
Right. And so the interesting thing is this can be done on an entity by entity basis.
Right.
So if you have 5 companies and collectively you're over the 25 million,
yeah.
you're subject to the rules, but then you can pick and choose which companies you want to make this election for to be subject to these slower depreciation rules to capture your full interest.
Because the interest expense is done on an entity by entity basis, right? Yeah.
So it really comes into play. You have to make a decision, and it may not be a short-term decision since it's irrevocable on, you know, do I forego some interest today at getting greater depreciation, or do I forego the depreciation to get the interest? And so you really got to look at a lot of moving parts in order to make that decision.
This is when these projections really come into play for future years. You don't want to make them in a vacuum for just a single year. So let's get to an example on this. So Mike and Sarah own a number of manufacturing plants in a single corporation, and their average gross receipts are $50 million, so they're above that $25 million threshold. Their adjusted taxable income, which remember we went over how you calculate that in the earlier slide, is about $5 million. So they finance this through heavily in capital and pay over $2.5 million of interest annually. So this legislation limits their amount that's deductible to $1.5 million. So that's at $5 million times 30%. So that $2.5 million they paid, only $1.5 is deductible, and the other $1 million carries forward. You want to make a note here, and it says it in the slide, because starting in 2022, adjusted taxable income is going to even decrease more because you're going to have depreciation that will be considered. Therefore, the amount of deductible interest will decrease substantially as well. So I think this is going to make people look at how they leverage their businesses and refinancing and interest rates a lot harder if they're falling into this trap.
Right.
Yeah.
And it may be prudent sometimes to look at how you're capitalized.
Yeah.
Instead of debt, maybe a preferred equity would be a lot better, considering you wouldn't be paying interest.
Yeah, very true. The next thing they put in place is something called the business loss limitation. So I want you to think of this at the individual level, because we're going to talk about this as it usually is affected by pass-throughs, so S corporation or partnership interest, or if you have a Schedule C, that you may have a business loss that overall flows through on your 1040, and prior to 2018, these business losses, as long as you had enough basis in the entity to take them, could offset all of your income, right? So they took in the provision in the new law and said, hey, we're not going to allow you to do that anymore. We're going to limit your business losses either to your gross income or $500,000 for married filing jointly, or $250,000 for other taxpayers. Where this really can become an issue is that if you have a pass-through, and we'll talk about this in a second, that throws off a pretty large loss, but you have high W-2 earnings or a capital gain in that year, you're going to pay some tax if you're married filing jointly and that loss exceeds $500,000. You're potentially going to have some carry forward on this piece of it. So those losses are disallowed and added to what's called your taxpayer net operating loss carry forward. And then in addition to that, these carry forwards are limited to either the carry forward amount or 80% of your taxable income going forward. So this is decided at the partner or shareholder level. You don't have to make this decision at the entity level. Where I do want to mention on this, on the net operating losses, is if you are a C Corp, this 80% of taxable income also pertains to you as well. That if you have an NOL that is created after 2017, so started with the 2018 year, you may be only able to deduct 80% of it going forward. Prior to that, any of your NOLs are 100% deductible, but you have a 20-year cap on how long you can carry them forward. And they also removed the carryback provision where you could carry back these NOLs to prior years where you had income and get a refund of taxes.
Right. So it's helpful to clarify. So if I have an NOL for 2017, nothing's different with those rules. Those rules are grandfathered in. Yes. I can deduct up to 100%, and then I'm on a 20-year clock to use those losses. Now, one of the themes in the tax reform that became very apparent with these provisions is Congress wanted to make sure that the wealthy paid some amount of taxes every year. So instead of being able to take losses in one bucket and offset basically all of your income in the others, they're really putting up a lot of these artificial walls to make sure that we're limiting our interest, we're limiting our losses, we're limiting our NOLs, we're limiting all of these things, so that way any current year income can't be sheltered by other factors in your situation.
Well, let's think about this too, and we'll go to this example, is how could you create a business loss? Well, a number one way is depreciation, right? Bonus depreciation. So let's say you go off and buy $1 million piece of equipment and you finance it over 5 years, you're allowed to deduct that as long as you have basis in the company to do that. Well, with this $500,000 limitation, if you take $1 million deduction and your loss is $1 million, let's say, and you had $200,000 of wage income, you won't be able to offset that fully. That $1 million would be limited to $500,000.
Right.
Yeah.
You almost need some other source of business income to offset.
Yes.
So if you had another entity that had the income,
Yeah.
you could offset it. It really is these other sources of income like interest and dividends and wages. And any other non-business income.
Yeah, so here's an example. So Helen, a married filing jointly taxpayer, owns a single business in which she materially participates, so she's active, and it generates an $800,000 loss. She has $2 million of other non-business income, and as John mentioned before, this could be from capital gains, wages, interest, dividends, pensions, annuities, anything, right? This other income can only be offset up to $500,000, not the previous year, which was $800,000. So that additional $300,000 business loss carries forward, which is good. It carries forward, but again, you didn't get the same benefit you were getting in 2017.
Right. You got the pleasure of paying $100,000 of extra taxes this year, and then carrying forward that benefit to a future year.
Yeah, and this will be kind of my theme as I talk about this. This is where we mentioned at the beginning is these decisions on depreciation, interest, business loss limitations really become interdependent on each other. You have to look at your personal and your business taxes together before making decisions. All right, one of the last things that we're going to talk about is on my side is meals, entertainment, and club dues. This is kind of a hot topic that has not been addressed by the IRS yet, and I think probably because they spent a lot of time addressing individual tax concerns. They put a number of notices out immediately after the tax law passed, clarifying things. And also they've been working on these regulations, which John's going to talk about in a minute, related to qualified business income. But one of the things the law said was no deduction for entertainment, amusement, or recreation expenses. So this could be buying tickets to a sporting event, buying tickets to a concert. They use the example in the law as nightclubs. Anything you're doing to entertain your customers for amusement or recreation is no longer deductible. Any other part of that is meals, so you buy food when you're at that sporting event, is also not deductible because it's not for a business purpose that you're there, it's entertainment. They still allow meals with a business purpose to be deducted at 50% until 2025. After 2025, those meals also become not deductible. But we don't have to worry about that today. 2025 is a few years away, so we're good on this piece. But it is important to note that those meals with a business purpose and not part of the overall entertainment still need to be documented of what the business purpose is. No change in that kind of role. Another provision that came along with this was saying, hey, how does this pertain to employees? And the thought process through the AICPA and published guidance under the code section has said, we still think that recreational meals and entertainment for employees are 100% deductible. So think of your holiday parties for your employees, company picnics. As long as you're not inviting customers or clients to those, they're considered still 100% deductible. If you're providing meals or refreshments for a business meeting within your company, for employees, stockholders, or partners, those are 50% deductible. They're no longer under that convenience of the employers where you're feeding overtime meals. This is where we're asking for additional clarification, and the AICPA has said, hey, is this really what you intended for this to be 50% deductible? And does this extend to coffee, water, snacks in the break room? Is this really, we're going to have to track our Sam's Club receipts to break that down to say that's only 50% deductible? And there's kind of three schools of thought related to this. And again, waiting for clarification on this. One is, bottom line, all food, including coffee and water, 50% deductible. It's the strict interpretation of the law. Second is the AICPA has sent letters to the IRS saying, really, our break room snacks, water, coffee, supplies like that, those are really falling more into the recreational. People talk in the break room, they're having coffee together, they're getting a snack. That really should fall under the 100% deductible items. You don't have to worry about it. And the third school of thought is Congress just never intended for it to stretch this far, like that you're really going through your receipts to break out what you buy for coffee and water. And they'll issue a technical correction to the law that says this wasn't our intent. It apparently just hasn't been the focus yet, and so we don't have a clarification answer on that.
Yeah, I think that's important to mention as the technical correction, is we are expecting, hopefully, by the end of the year, for Congress to pass some sort of follow-up legislation to clarify a lot of these things. I read an article about a week or so ago that Orrin Hatch, who is the chair of the Senate Finance Committee, was writing a letter to the IRS to say, hey, here's what we meant with the law, because he didn't like the way some of these are being interpreted. So I would expect that there's probably more tax reform and more legislation coming, which makes all of this all the more challenging, but it did create interesting things like this.
Yeah.
Even the AICPA was like, well, we don't know if our dues are deductible, because the way you read the law, if you could get there with that. So,
oh, definitely. So the thought under dues, which is one of our questions, was like, are club dues non-deductible? Because it said in the law, these are, if you're in a club that's formed for business or recreational purposes, so like the Chamber of Commerce, the AICPA, are those no longer deductible? A lot of smart people have come together and said, we don't think that's what they meant. We think what they meant is expenses incurred for entertainment at those type of clubs are no longer deductible. So a good example is country club dues have never been deductible. But if you went and played a round of golf at your country club to entertain a client, that was 50% deductible. That was entertaining, and just because it was at a country club didn't mean that it wasn't deductible. Now that's an entertainment expense, which is 100% deductible. Similar to maybe another club that might have some sort of event that is purely entertainment. They all go bowling. There's nothing related to the business purpose of that club. What you pay for that might be entertainment expense and 100% non-deductible, which I think is good news. I don't think by any means Congress thought, oh, we're going to make people not pay their Chamber of Commerce dues and make them non-deductible. That doesn't make any sense.
So before we move forward, let's just poll our audience based upon what we just talked about. So based upon the information we have so far, will tax reform impact the amount you spend on meals and entertainment? So let's give everybody just a couple more seconds to complete the poll. Okay, we're going to give you a few more seconds. We have a few more responses coming in. And we're going to close the poll and share the results.
Yeah, so the answer is no. 53% said you're not going to change the way you spend things on meals and entertainment, which, I mean, I think is, I hope that you're not going to start buying coffee for your employees. We want to keep them well caffeinated and working, right? But you may think a little bit harder on the entertainment piece of things. All right, John, now I'm going to turn it over to you.
Okay, so I'm going to talk about the qualified business income deduction, which we call it, kind of dubbed the pass-through deduction or the 20% deduction or the small business deduction. I think this is an area that I know I personally have probably gotten the most questions on of any of the provisions in tax reform. So in August, the IRS did issue kind of their much anticipated regulations around this deduction, and they promised us that they would give it to us in June, and then June went by, and then July went by, and now in August we finally got the information. So the PDF was 183 pages, which we were all super excited and anxiously waiting to read, which kind of shows you how insane we all are over at our end of this place. But so we'll go through kind of what these provisions are, talk about it at a high level, and kind of talk about what kind of planning opportunities we have around that. So just to kind of give you kind of a high level view of the deduction provides a 20% deduction for the amount of qualified business income from a domestic business that's operated as a partnership, S corporation, sole proprietorship, trust, or estate. So one of the glaring things about that definition is this doesn't include C corporations.
Right.
So this was Congress's answer to, we gave the C corporations a massive tax cut. So we're also going to give the small business side of the equation a massive tax cut as well. And so this is the 20% deduction that you get. If your taxable income is less than your qualified business income, then it's limited to your taxable income. So real quick, if I had $1 million of qualified business income, but I only have $100,000 of taxable income, I'm not going to get a 20% deduction on the million because that would throw me into a loss. So it would be limited to 20% of my taxable income.
That's a big piece right there, because I think that's where it becomes, again, prudent. You can't just look at the business itself and then not look at the individual's taxable income to figure out their tax projection. There's no back of the napkin calculation.
No, and then you also got to go again, look at the loss limitations and
Yeah.
the depreciation, and there's
Interest.
all these things that kind of play into, this is why we said that businesses are just more complicated.
Yeah.
So the other thing that they did on this law, and we'll kind of go through this, is they made the limitations apply once your taxable income exceeds what they call the threshold amount. So the threshold amount is $157,500 if you're single, or $315,000 if you're married filing jointly. So it's a fairly decent amount, but it really becomes kind of a stark dividing line on how this deduction is calculated. And then they also issued 6 new regulations, and we're going to go through each of them fairly quickly.
And just to clarify, the taxable income is the first hurdle. Like that's regardless of what your income is. Your 20% is the taxable income rule versus QBI. The limitations are the ones you're going to kind of talk about that apply once you hit those thresholds.
Yeah, if you don't have any taxable income, you're not getting a deduction. That's
bottom line. Yeah.
But once you do have taxable income, once you exceed certain thresholds, they put in additional limitations.
Yeah.
So the first reg was the operational rules. So this kind of spelled out, how do we calculate the deduction? They basically broke down the computation into 3 different categories. Below the threshold, 157,005 or 315, they basically said if you're below the threshold, it is 20% of either your qualified business income or your taxable income less your capital gains. So it's a pretty simple calculation. If you get down to above the threshold, above the phase-in, then it starts to get more complicated because you have a W-2 limitation, or you have a W-2 or the greater of the 50% of your wages, or 25% of your wages, and 2.5% of your UBIA, which we'll talk about here. And then also it started to limit your specified service trader businesses, which we'll also talk about. So within the phase-in, there's also a separate calculation now that basically says if I'm within the phase-in and I would be subject to a limitation, I'm going to prorate how much of the limitation I'm subject to based on how far I'm into the phase-in. So that sounds complicated, but the easiest way to think about this is the phase-in amount is $100,000. So you're above the phase-in married at 450. So if your income is 365, you're halfway through the phase-in. So if you were going to get the full deduction, and we'll just throw out a $50,000 deduction, and you're halfway through this phase-in, and if you were above the phase-in, you would get no deduction. You're only going to get half of the deduction.
Yeah.
So it basically, you calculate it as if you basically calculate it both ways, and then you take a reduction.
And this is where a lot of planning comes in if you're in that middle ground, right?
Yeah.
Yeah.
I think it really shows, well, if I would be subject to some of these limitations, and the service business is a big one.
Yeah.
Maybe I could do something to reduce my taxable income, like these depreciation rules or retirement plans or something like that. And $1 of a deduction coupled with this increase or decrease in the reduction on this deduction could actually generate more than $1 of a reduction in taxable income. So it has like a magnifying effect on these deductions. Which
So
is
simple.
Yeah.
It's so easy, right?
And we're supposed to know all of this,
Yeah.
well in advance to plan by the end of the year.
Right.
It also provided some special rules. So one, it doesn't reduce your basis. So this kind of operates like the deduction that it kind of followed, which was called the domestic production activities deduction. So it's just a deduction on your 1040 based on the character of this income. It doesn't actually flow through as a reduction in basis on your pass-through.
Which is good news.
It is good.
Yeah, because you basically never have to recapture this deduction.
Right.
Yeah.
It doesn't affect your self-employment income.
Bad news.
So that is bad news because and there's some other like retirement plans are the same way where you're paying taxes on this income, and then you basically get a reduction in your income tax rate. It's not a full deduction. And then it also includes Puerto Rico. So when we say it's a domestic business, Puerto Rico is a U.S. territory, so it includes Puerto Rico. Okay, so the second one is the determination of wages and the UBIA. So as we talked about, there's a limitation on the deduction, and once you exceed the threshold amount, you're basically limited to either a greater of 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of your unadjusted basis after initial acquisition of property, which is a fancy word of what it originally cost you.
And just to clarify, the wages, when we talk about 50% of the wages, that's at the entity or the business level, right? Not my personal wages.
Right. So, and they actually went through a calculation of how do I determine W-2 wages. So the first thing you do is determine the total W-2 wages paid during the year, which seems like a very simple process. You go to a form that you file with the IRS called W-3, and you look at the calculation follows the Medicare wages, which is basically your gross wages without any reductions for like retirement plans and that sort of thing. And that's your total wages paid during the year. The other caveat that they threw in there is that your payroll tax returns have to be filed timely, and they say within 60 days of the due date. So if it's a little bit late, that's okay, but you can't go back a year later and say, oh, I'm going to file payroll tax returns.
Right.
The next thing you do once you say, okay, I paid this many W-2 wages, then I have to decide, okay, do I have more than one trade or business? And if so, I have to allocate these wages between my various trades or businesses. So just because this trade or business generates income, I may not be able to take full credit for all of my W-2 wages if I have multiple trades or businesses I'm engaged in. And then the final thing is you have to determine which wages are allocated to QBI, which should be a straightforward calculation. The rule of thumb is that if the expense is determined in calculating the income number for QBI, then it's pretty safe to assume that those wages would be allowed for the limitations.
And one of the things that I've had people ask me is if I have a PEO, so I'm leasing my employees, do those wages count?
Right, and so they did clarify that they do.
Which is great, yeah, makes sense.
So that helps to provide some relief in that, you know, you don't have to have direct wages. You can count these wages from other things. The real big stipulation is that the person that is receiving the wages has to be classified as a common law employee, which means, you know, they're your employee of this trade or business. You have the ability to direct them and everything else, and then how they're compensated, whether it's through a PEO or by you directly, you're allowed to count that.
So no independent contractors.
Correct.
Okay.
The other thing was the UBIA. And so what they said is if you have qualified property, to the extent that it's held by the business, used in the business, and the depreciation period has not ended before the close of the tax year, with the caveat that no less than 10 years, you can count 2.5% of the cost for purposes of these limitations.
That's a big win for real estate, right?
A huge win for real estate.
Yeah.
So Bob Corker caught a lot of flack during the time because he apparently is a real estate guy and, you know, had to say on whether this or not got in there. And so this was huge for real estate because you can own a lot of property and you can generate a lot of income without very many employees. Right. And so what this does is this lets real estate entities in on the deduction. But the tricky part is the property held by, or that hasn't had the depreciation period ended. Yeah. Well, as we start looking at things, if you bought something 30 years ago and it's fully depreciated, you don't get any UBIA for that asset. Or if you do a cost segregation, you know, and there's items broken out in the 5-year property, well, in year 11, you're not going to be able to count that as an asset as well. So it really becomes kind of complicated on how this is even calculated, given that you have to basically parse out where am I at on all of the assets that I'm still depreciating.
Yeah, they did make a nice exception here with the depreciation period of 10 years because they didn't hurt you by accelerating your depreciation into a 5 or 3 years. They said we're going to say it's at least 10 years to use it, which is good.
It is good. Okay, so the next one is defining qualified business income. So it basically spelled out what is qualified business income. I think it's pretty straightforward. I think what really is notable is what it doesn't include. So capital gains and losses, and I put including 1231 treated as capital gains. Well, 1231 is the code section for the sale of business property. So if I have an apartment complex and I hold it for 10 years and I do a good job creating value and I sell it, I'm going to have a capital gain in the form of a 1231 gain on the sale of that property unless I do a like-kind exchange. Well, that gain is not eligible for the deduction. And I suppose the logic is you're already getting a preferred tax rate.
Right.
So you're not going to kind of be able to double dip on a better tax rate plus that. Interestingly, if I have some of the 5-year property, I'll be subject to what's called recapture, 1245 recapture. That income, ordinary income, or 1231 recapture would be allowed for the deduction. So it's only the capital gains.
Yeah. And again, I can see the reasoning for not wanting to reduce what you could potentially be at 23.8% or 20% even further down.
It doesn't include any interest or dividends. And that includes interest that I would from loans that I make to the entity. So this becomes an entity level decision of how do I generate my earnings? Do I pay myself interest? Do I pay myself W-2 compensation, which is also not included, or do I generate, entity level earnings? The W-2 income, so the IRS, if you're an S corporation, says you have to pay yourself a reasonable salary. So, and that reasonable salary isn't allowed for the qualified business income either. And then the next 3 are partnership provisions, but basically any guaranteed payments to a partner aren't allowed for the qualified business income either. So it really creates a challenge in that you really got to structure your partnership agreement to provide compensation as just box 1 ordinary income or box 2 rental income, instead of being more flexible, say, let's just call guaranteed payments and call it good.
Right.
Okay, so the next one is aggregation. This was huge. This was probably the biggest thing that I was waiting on from all the guidance, because what this allows you to do is this says, okay, for purposes of applying these limitations, I'm allowed to group together a portfolio of my trades or businesses as long as they meet this tests for applying these. So if I'm short on my W-2 wages or my UBIA from one entity, I may be able to take another entity that's over and net the 2 of them together, which I think is great. But it also comes with challenges. If I have an operating business, I'm going to generate a lot of W-2 wages, probably not a lot of UBI. If I have a real estate business, I'm probably going to generate a lot of UBI and not a lot of W-2 wages. If I have both, it may not make sense to aggregate because I'm only allowed to pick one limitation. So it's a really challenging scenario to plan around. So in order to aggregate, the conditions are it must have common ownership, and the ownership must be in place for a majority of the year. So you can't walk around with ownership on December 20th and be good for aggregating everything at the end of the year. It really has to be in place and legitimate. You can't combine an SSTB, which you're going to talk about. That's a specified service trade or business. So if I'm an accounting firm, I can't combine an apartment complex that I own. And then the last thing is that the business must meet 2 of the following 3 criteria. So 1, the trades or businesses provide products and services that are the same or customarily offered together. So if I own 2 apartment complexes and same thing, then that would meet that test. If I own an apartment complex and a candy store, well, that's different.
Right.
The trades or businesses share facilities or share significant centralized business elements such as personnel, accounting, legal, manufacturing, purchasing. So a lot of our companies that have multiple entities like this, they meet that test because you have the same bookkeeper, you have the same kind of central business office, even though you're operating multiple entities. And the last thing is that trades or businesses operated in coordination with or reliance upon one or more of the businesses in the aggregated group. So an easy example for this is if I have 10 apartment complexes, well, I probably also have my own management company, and the management company provides management services to the apartment complexes. So you can see where, they're relying on each other and there's interdependencies. If I own that candy store and I also own the building, well, with the candy store, I'm renting from the building, so there's interdependencies there as well. So you have to meet 2 of those 3.
Where I can see this could be a little bit tricky is if you're just an individual investor who invests in different businesses that isn't really the one coordinating the business elements, or you have different partners. it really means as CPAs we have to ask a lot more questions to
Right.
decide if we can aggregate them or not.
Yeah, like who are your partners?
Right.
And you may invest with different investment groups, and those may not be able to be aggregated across investment groups.
Yeah.
So it becomes really tricky. Okay, so specified service trades or businesses. So the other massive limitation that they put into this deduction is even if I met the W-2 limitation and everything was good, if I'm above the threshold amount, there's a limitation for something known as a specified service trade or business. And so these fields, which I've listed on this slide, the health, law, accounting, actuarial services, performing arts, trading, consulting, athletics, financial services, brokerage services, investment management, dealing in securities, and then any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees.
Yeah.
If I'm engaged in any of these fields and I'm above the threshold amount, then I'm limited to 0 for the deduction, right?
That's huge.
Subject to the phase-in, which
Right.
says I have the next kind of field of 50,000 if I'm single or 100,000 if I'm married to kind of phase this in. But once I'm above the phase-in, it's just 0.
Yeah, that's it.
So accountants got gypped.
Poor lobbyists. Apparently, poor lobbyists on our side.
Yeah, and so we don't get this deduction if we're above these income amounts.
Right.
So I read an article from Forbes, and it was called "Beautiful Loser," and basically what it said was there's winners and losers in the tax code, right? And it was a lawyer who was also kind of put out of this deduction. He was like, how come some businesses are winning and other businesses are losing? And he made it his mission to say, well, it's so complicated, I'm just going to make it up on the revenue side instead of the tax side.
Yeah.
But so the nice thing about these regs, and we're going to talk about this, is they actually went through and clarified, what does this mean? Like the last one, what does that mean? Well, I found out what that means is if I'm Michael Jordan and I'm endorsing a pair of Nikes, that's what that last one means, which on the face of it, I didn't really understand at first.
No, they actually did a really good job in the regs of clarifying all of these specified service trader businesses because I think it was very gray for a lot of us.
Right.
Especially the consulting one, of what that means, these trader business, were realtors going to be involved, insurance agents, what did it mean in dealing in securities, things like that.
Yeah. So they basically went through each field and said, what's included and what's not included. So for accountants, they said accountants, enrolled agents, tax preparers, auditors, and kind of listed out kind of all the functions of our field, which made a lot of sense. But I think what's really big from that is they also said these things are not included. So the first thing that was kind of a theme, capital intensive periphery trader business, which is a word I made up, but it gave an example and said if I operate a health spa, that's not necessarily in the health services field.
Right.
Or if I operate a stadium, that's not in the athletics field. So if you think about going to a football game, the stadium is not a specified service trader business, but the baseball players or the football players are. So,
Well, and once again, we have to go back to that specified service trader business because I think if anything has the word service in it, people automatically like, oh, I don't qualify. But that's not really true. It's
Right.
a specified service.
Right. So I think the nice thing about this is it's defined fairly narrowly.
Right.
So absent any additional guidance or as court cases come out, I think you kind of have the reins to say, they've kind of painted a fairly solid box in what is a service business, and anything outside of that business, I think it's fair game to say you take this deduction. If others were interpreting this, you would say, oh, of course the stadium is athletics. That's where you go to watch the athletics.
Right.
So, but it was excluded. Real estate agents and brokers are not brokerage services. So the AICPA needs to hire their lobbyists.
Yeah.
Because they got a better lobby, which is a huge win for our real estate professional clients.
Yeah.
Real property managers are not investment management, so that's also a huge win. Pharmaceutical and medical device companies are not healthcare, which makes sense, right? Because you're selling IP, you're selling devices, you're selling stuff, you're not charging fees for your time.
Right.
Broadcast or disseminating videos of performance or events is not athletics or performing arts. So again, I think this helps paint the box and defining it fairly narrowly. The sales of training and educational courses is not consulting. And then A farmer or manufacturer who engages in hedging transactions is not trading. So, they're obviously that could be construed as trading, but since it's part of their business and what they're doing, commodities are kind of part of the agricultural.
Right.
So the other thing that the regulation did was it addressed businesses that have a mix of service and non-service income in their trader business. So they basically put out a de minimis rule. Instead, if a business has 25% or has 25 million of gross receipts or less, it is not a specified service trader business if less than 10% of the gross receipts would be considered services. And then once you exceed the $25 million threshold, it's a 5% test. So the best way to look at this is I'm a contractor and I'm engaged in the trader business of constructing stuff. And I end up with a side gig where I become an expert witness in a court case. Well, I can do that, and as long as I'm under this 10% gross receipts threshold, then that income wouldn't necessarily disqualify me as being a specified service trader business. So it's a really good rule, so that way you're really not having to really parse through every dollar of your revenue with the IRS. The other thing it did was it looked at the other side and said, okay, if you really clearly are a specified service trader business, we're not going to let you just kind of get out of it. So there was very early on this strategy called crack and pack. And what they said to do was, if you're an accounting firm, you can take the deduction, no problem. Just create an employee leasing company, rent your building, strip out all your earnings. That way you're not earning any service income. It's all from an ancillary type service. And so the IRS said, no, no, no. If you have a trader business that otherwise would qualify, but it provides more than 80% of its services to a specified service trader business that has common ownership, then it is also a specified service trader business. And then if you are a non-specified service trader business and you don't have that common ownership, then you would prorate the percentage. The other thing it did was said, well, if you have a non-specified service trader business and it shares costs with a specified service trader business but has less than 5% of the gross receipts, then it's also included as a specified service trader business.
So John, how many articles do we get forwarded by clients telling us that they said, hell, this lawyer says to do this, or this accountant, and not even necessarily accountant, just people are saying, hey, if I divide up my medical practice so that I can sell this here, this here, this here, then I can get 20% on all of it.
Right.
Yeah. Is this true? And we said, we gotta wait, because if you're making it public, the IRS can see it too.
Yeah.
Yeah.
And they clearly looked at it and really wrote guidance around that. Now, whether or not it will stand in courts or anything else is another story altogether.
3 to 5 years, we'll know, right?
Yeah, exactly.
Yeah.
So the last one, the non-specified service trader business, less than 5% gross receipts. The example given in the regs is if I'm a dermatologist office and I provide medical services, but then I also sell skincare products, and that's a really minor part of my business. I can't say, well, it's a separate trader business, so that income qualifies. Okay. So the last reg was about relevant pass-through entities, and it just broke down the rules on how to report this to your members, and provided rules also for trusts and estates, because trusts are also allowed to take this deduction. Trusts are kind of a quasi pass-through in that if you have a complex trust, it can pay taxes at the entity level, or it can pass through its earnings in some cases to the beneficiaries. And so what they did was basically provided rules that this deduction would follow that income. So if the income is retained at the trust level, the deductions at the trust level. If it's passed through to the beneficiaries are get the deduction. It also provided an anti-abuse rule for trusts. So it basically said, well, if you have this threshold amount, well, why don't I just create 50 trusts, right? And I can divide all my income in between all of those trusts, and I'll keep everybody under the threshold amount, and I'll be good to go. And they said, no, if you're doing that, we're going to squash it.
Right.
So.
But it is, I have heard from a number of people this trust idea of like, hey, if you give away 25% of your income to a trust for the benefit of your kids or your grandkids, they could be below the threshold and you could take more advantage of the 20% deduction. And one of the things I always say is, okay, but you're giving it away.
Right.
Yeah, I mean, it has to be a completed gift.
Yeah. So there becomes some challenges in there, but there are some strategies.
There is, I agree.
Okay. So that was a real quick, high level, 6 slides, about 100 something pages. So we're going to go through an example, and really what I want to illustrate is kind of how wacky the mechanics are on this deduction. So you have Pat. Pat owns a lawn care business and was a sole proprietor, and he earned $100,000 in his business. He didn't have any employees, and he only had a negligible amount of equipment, and with all of his other non-trader business income, his taxable income was $120,000. So he's under the threshold amount. So it basically says what's 20% of the lesser of your qualified business income or your taxable income. And he gets a deduction of $20,000, which is his $100,000 of qualified business income times 20%.
Pretty simple.
Pretty simple,
Yeah.
pretty straightforward,
Yeah.
right? So Pat marries a doctor, and his income goes up. So he earns the same $100,000, but now his taxable income is $500,000. So now his deduction is 0. And so when you're going through, you're saying, why? Well, his tentative deduction didn't change. It still would have been $20,000. And then he's now above the threshold amount. He's above the phase-in. So now you have to start to look at the limitations. Well, the first one, is he a specified service trader business? No, defined narrowly on those fields. I don't think he falls in any one of those fields. So next you have to look at the wage and UBIA limitations. Well, he didn't have any employees, and in the real world, he may get a very small amount of the deduction based on 2.5% of the cost of his lawnmower. But, for our purposes, we're just going to say 0. So he had no wages and he had no cost basis, so his deduction is 0. So this kind of goes into our next segue is, if I'm Pat, I'm married the surgeon, and I'm good to go on the income, but now I'm subject to these limitations, what can I do to plan? Is there anything I can do in order to take more benefit of this deduction and lower my taxes? So the first thing to look at is corporate structure. The obvious question is, do I forego this deduction entirely and become a C corporation? And I think that's a question you have to ask, and I think it's fairly limited when it would make sense, but it's definitely a question worth asking. But even for him as a sole proprietor, does it make sense for him to be an S corporation? Because S corporations pay their owners salaries, so you would generate W-2 wages.
Right.
So then it would just come down to a question of how much of your earnings would you be required to pay out, and how much could you actually flow through as income, qualified business income. That's kind of a gray area. The next thing you want to do is determine if there's any limitations. And so say I'm already an S corporation, and I'm subject to it because of my wages too low, maybe I give myself additional wages. So that way I can pay more wages and raise the threshold.
Circular equation.
Yeah, exactly. Adjusting capitalization policy. So with this 100% bonus depreciation, our wisdom for the past few years since the tangible property regulation is saying, hey, the IRS set a $2,500 safe harbor. If it's under $2,500, we just expense it.
Right.
Well, maybe it makes sense to lower that capitalization policy to $200, pay the cost and time and effort of keeping track of everything on a depreciation schedule, but increasing our UBIA, so that way we can increase our limitation. Applying the aggregation rules, really sitting down at the shareholder and partner level, and really looking at the entire portfolio of businesses and making sure that you're maximizing and you're crossing the limitations, so that way you can increase that. Or managing the threshold amount, like we talked about. If you're in that phase-in and you're subject to these limitations, a $1 deduction from one thing ends up increasing your 20% deduction, which is you're getting more than $1 benefit. So those retirement plans and those sort of things become more valuable if you can find a way to push your income below that threshold amount. And the last thing is maximizing QBI. So sometimes we see S corporation shareholders that pay themselves an unreasonable salary on the high end. So it's saying, well, what would you pay somebody to do your job, and kind of bringing that into more of the realm of reasonableness, paying interest on a loan to the company that you own 100% of. There's various areas and ways that earnings have been stripped out of a company that may not make sense. Re-examining your partner compensation to reduce guarantee payments and increase income allocation. So there's various things that could be done to plan, but it really does require some thought.
Yeah, and again, looking at it all as a big picture.
Yeah.
Big picture.
So we're going to launch our third polling question for today. So after hearing about the presentation, do you all think that the tax code is simpler? And we'll give everybody a few seconds to respond to this one.
But you can file your taxes on a postcard.
That will make it so much easier. If anybody hasn't seen, they have put out the draft 1040, and it is very short, but what they made it short, page 1, they said attached schedule, attached schedule, attached
Yeah, there's
schedule.
like 6 or 7 of the schedules, which is just mind-boggling.
No, I'm not surprised by that answer. It is definitely on the business side, not simpler.
Simpler.
Do we have any questions, Stacy?
So we are actually running low on time. It's 11:02. So for those of you who submitted questions, we'll be sure to follow up with you so that your question does get answered. But, you know, I just wanted to thank both Aaron and John for taking the time to walk us through these new developments related to tax reform. It's been very enlightening. But I'm assuming that many of you are going to have a lot of questions with regards to your personal situation. So we highly encourage you to reach out to us for help with tax planning before year end, and just for help with addressing any of your questions or concerns.
Yeah, I definitely think it's worth a call to your CPA.
It is.
And if you're not a client, it's worth a call to James Warren Company. Because there's a lot of opportunity here, and with complexity comes opportunity. But it's something that you definitely need to get it on the front end. And on April 14th, it's too late to make that decision.
It is, and we really don't want to be making these decisions on April 14th. Like, it's just not prudent, and it's not going to be valuable for anybody. It's much more in advance or even after the fact.
Great. Well, thank you all for attending the webinar, and we hope you have a great day.